Mode.
Hey everybody, Preston Brent here with our trader user group. This is for the weekly roundup, week ending July the 6th, 2018. Really interesting past week. We've seen the Trump coming out with a warning to NATO, but more important, we saw the tariffs were on. The fuse is lit. Firing off 35 to 50 billion in tariffs on China, and they responded in kind. We saw also Merkel over in Germany barely escape losing her coalition in Germany due to the immigration issue. We saw in Mexico Obrador win the presidential election in Mexico. He's a stated socialist, but he seems to be walking a fine line between what's good for business versus what's good for the common folk. So it'll be real interesting to see there. And of course, as I said, the trade tensions, they're going to continue, but the trade tariffs, it's on, the fuse is lit. Now, what's really interesting is this Friday, we didn't see the markets really sell off hard. And that tells me that the markets had priced in this initial shot across the bow of these 35 billion in tariffs with China. Now, I've been saying all along that the tariffs are the lid holding the markets down. If these tariffs go away, we're going to take out the January all-time highs because the fundamentals of the U.S. market are very strong. If you look at when these trade tariffs really became an issue with the market, all right, they really became an issue since they become an issue with the market. The S&P is down, and that goes back over a month or so. The S&P is down about 0.7%. Okay, the German DAX, however, is down 4.7%. They would be impacted more. Most of Europe is down more, and then China, they're in a bear market, and their index just since the tariffs were announced, or the potential of tariffs being announced about a month ago, they're down over 9.3%. So if you look at the percentages of indexes down, the U.S. is least affected, China being most affected. This is why you hear Trump saying we've got not much to lose. Although I think we're going to see some more downward action in the indexes if he takes it to the next level, which he's promised 200 billion in tariffs. And then he asked his group, we can take another 300 billion on top of that, essentially taxing every Chinese good that comes in. Now, China can't retaliate like the U.S. can. One of the things that we're seeing is that the yuan has mysteriously gone down in currency valuation. That's possibly one way, but China can't take the yuan and devalue it too much because then they're going to have an issue with capital flight leaving that country. They know that. And then the other big hammer that they have, of course, they own over $1 trillion in U.S. Treasury securities. They can't just go out to the market and dump that either because that'll hurt them more than anybody else and taking huge losses. So China does have a little bit of a pickle. I believe what they're playing is a long game with Trump, but I think this is all going to come to a head here in the next 60 to 90 days, meaning as we wind down the summer months. Now, as this is just my speculation, I've looked at a number of analyst reports, and it's 50-50, guys. 50% say this is going to get worse. The other 50% say it's a negotiating ploy, blah, blah, blah. But the markets always price in for guidance and risk. Now, the markets, as I've always said, since these tariffs have come up, are really good at pricing in risk, but it's horrible at pricing in uncertainty. In fact, when you throw uncertainty into it, the markets tend to overcorrect, either up or down on uncertain issues like these tariffs. So we're going to see continued downward pressure, although I do believe over the next few weeks, one of the things we got is Q2 earnings coming up, and they've already raised guidance. Analysts have raised guidance from 19% to 19.5% earnings growth. Another very strong quarter. Now, this week, I kind of view it as officially kicking off on Friday the 13th. You know, it's an ominous date, Friday the 13th. But we've got JP Morgan, PNC Financial, we've got a regional bank, First Republic, we've got Wells Fargo, and we got Citi, all holding their earnings on Friday the 13th. And the option market is already pricing in a bigger than normal expected move, both up and down. Now, banks have been killed this year, as you guys know, or should know, primarily because of the yield curve. Banks borrow short and lend long, so they make their net interest margin. But when the borrow short interest rates are approaching the borrow long interest rates, right? Then banks start taking it in the shorts. I mean, the yield curve right now is about 28 basis points. And that's the lowest it's been since August of 2007 when the markets imploded. And just as an FYI, an inverted yield curve, that would be the short end of the duration, the 2-year or less, is higher than the 10-year. That would be an inverted curve, has preceded every recession we've had since 1970. And there have been 7 of them. And it's preceded that by anywhere from 3 to 5 quarters. So that would be, anywhere from 6 months to a year. Is it going to be different this time? Well, what's that quote by Ernest Hemingway? I think it's Ernest Hemingway. He says the past may not repeat itself, but always rhymes. I believe that because, and this is just my belief, and my belief, I guess you could probably say, is worth no more or no less than any other analyst or any other trader in the market. But my belief is this time it may be slightly different because they've injected, and when I say they, I don't mean just the U.S. central banks, but I also mean Japan, South Korea, China, Great Britain, all across Europe, India, Turkey, even South American markets. They've all injected major stimulus into their economy to create and force money into the equity markets, which is where we've seen this huge run. We're on 9 years of a secular bull market. And I've always, people say, well, we're due to end. Well, we're not due to end. It can end when growth stops. But there are a number of, things on the horizon that could stop growth. One is rising interest rates. And the Feds always seem to undo what they create to begin with. It's kind of like the arsonist that starts the fire, and then they're the first to show up with the water to put it out. I mean, sometimes it just doesn't make sense. And you would probably question, well, then why have the arsonist there to begin with so you don't have a fire to begin with, and you don't need to worry about putting it out because it never started. But that's for another show. That's for another topic. But I'm looking at these markets right now, and this is kind of what's on my mind. So I do believe next year the Feds, the U.S. Feds, are due to take another, more so than the past year, reduce the balance sheet. And remember, the Feds now are no longer at the Treasury auction soaping up all of this additional balance sheet debt. And with trillions of dollars due to be taken out of the balance sheet, or at least a $500 billion, someone's got to make up that difference, or some country or some sovereign wealth fund has got to come in and buy treasuries because the U.S. is not going to be buying them now. They're going to let them expire in an effort to reduce the U.S. balance sheet. Now, my thinking is that as more and more treasury debt comes to market, other countries are going to gladly buy it up, but they're going to demand a higher interest rate to buy them. That's going to jack up our interest rates, which will drive bonds over. And that could prevent the yield curve from inverting. But if that doesn't happen over the next, if you look at the Fed dot plot, over the next 6 months, it suggests the yield curve could invert in Q4 this year, Q1 next year. All right. So if you have that kind of inversion, then that would put a recession into the end of 2019 into 2020 timeframe. So that's why you've got all these analysts saying what they're saying. Either way, for our user group and our members, the most money we made in the markets was in 08 and 09 with the market implosion. And then we made some good money stepping in front and picking up really cheap money off the curb because we were prepared for the 08 drop, 09. So if you're not a member, I would encourage you to come on in. We're taking on an international audience, which is really good because we do everything from an international macro perspective, and then we work our way down. So I would take advantage of that. So now that we've gone through some of these things that I see here, the market jitters and so forth, let's take a look at the current markets and just kind of what I see at a big picture. On the screen right here, I don't have any of my indicators on. I've got the E-mini S&P 500 futures. Okay. And I've got us looking at this here, and we open the markets right about here. All right. That's kind of where 2018 roughly opened. And you can see we've kind of gone back and forth around the 2018 open, right? So this is about where we open for the year, right in that area right here, okay? And you can see 2018 down there, and if I were to draw the line, right, that's about where we open, roughly. So now we're looking at this, and the next big hurdle is right up there, folks. That is what I call our R1 value, our first level of major resistance. When we failed at that point right there, I got everybody hedged in our group, and I said, we've got to be ready for the downside. We caught ourselves right here, but if I were to draw this trend line, well, that's not a good trend line. Let me redraw this trend line here. This is what I get when I try and hand draw these things on this stuff. If we look at this trend line like that, there it is right there like that, okay? So, and then here is the opening price right there like that, right around the 2,700 level, give or take. So that is kind of what we're looking at here. And then here is the resistance point right here, just like that. Call it roughly 2,800, okay? It's a zone, and I call it our R1 zone right here. So we're going to run back up, I believe, into earnings right up in this area here. I don't see anything to step in our path between now and then. You can see this volume over price right there. If I were to draw it, that is where most of the buyers and sellers are finding an equilibrium in value, right? Where buyers and sellers are pretty much equal. So that would be like an S1 stop below our first level of support, right around in that area right there. Okay, around 27.25 area, roughly. You can see the MACD is crossed up. We're below the zero line. This would suggest a nice impulse move back up to the R1 level here around the 2,800 into earnings. As I said, this Friday, we got banks coming out. JP Morgan, PNC Financial, Wells, Citi, right? The big ones, and then a couple of regionals, but the big banks. Everybody's going to be watching what their guidance is. Again, Q2 is forecasted to come in good. For us to climb much above this, I'd be very wary. If we get up into this area here around 28.25, 28.50, and I could see it, all it's going to take is a Trump tweet. The two T's of the five T's that threaten the markets this year. The five T's, as you guys remember, I kind of came up with this in my crazy mind, but you got the tightening of the Fed with interest rates. You got technology, because technology, the FANG stocks and a few others are really driving the Nasdaq dramatically higher, right? So you got the technology, you got the tightening. You got the tariffs, the trade tariffs, the third T, which is really providing a lot of the overhead resistance. And then I had the wild card, the two T's, the Trump tweets, which could be related to all of the above, but mostly trade tariffs. That is going to keep a little bit of a pressure lid on this, but that I do believe the markets near term are looking to run a little bit higher. The fact that we moved up Friday after the formal kickoff and the fuse is lit to the 35 billion in Chinese tariffs. In the scheme of things, it's very small. The markets have factored that into the markets with a slight down move. Now the market's going to move to the next, which is 200 billion, which is a huge number. And depending on how Trump plays it, depending on how he tweets, depending on how China counter responds, we're going to get a lot out of that. Now, Europe has already come out and said they're willing to negotiate on the car tariffs and everything else. Trump will be in Europe next week, so we're going to get some feedback on that. Guys, if all of these things are removed, we're going to come up and we're going to take out the highs here. We'll probably even run up to 2,900 on strong Q2 earnings, assuming the tariffs are taken off the table. Tariffs not off the table, I don't think we're going to get up there. If we do, it's going to be like this big move like this, and then I think there'll be some backside, downside action until the tariffs are off the table. All right, so that's kind of how we're looking at it. That's kind of how I would play the market near term, running up into earnings, and then we're going to find this overhead right here around the 2,800 as our first major area to take out. If we take it out, we may run up real quick to 28.25, pull back to the 2,800 and test it again, and then we'll see where we want to go. Okay. If I put everything on my screen, if I put all my indicators on the screen here, right now you can see it's all colored in, guys. Right in this area here. And this is the area, the zone, the R1 zone and the S1 zone right here, which is where all the volume over price is, and then the 2018 open price. So this is kind of what we're sitting on. So the US is the only pig in the pen with lipstick. And if we look at Nasdaq, if we come over and just take a look at Nasdaq, which is one of the stronger indexes, right? We bounced off the 50 EMA and we're running back up, and I do believe we can run up. We should have good earnings coming out, run up near the 2018 highs on Nasdaq. Technology has been a very strong one, but then the one that I would favor over Nasdaq would be the small cap, which would be the Russell. If we look at the Russell, you can see here the chart from a technical perspective is even stronger than Nasdaq, and we're only just a few points off of our all-time highs. I mean, the Russell right now is at 1701.70, all-time high 1720, so just 19 points roughly. And we've made new all-time highs. We got a cross in the MACD. Everything is showing bullish movement up, and we should see that going into earnings again. And you can see a more of a volume over price in this area. So this is where buyers and sellers are fairly equal right now. Throw in stronger earnings, and I could see the Russell coming up and just poking its head above the 1720 level this week, making new all-time highs. Okay. However, let's look at some of the other pigs in the pen here. These are all fairly good with lipstick on it. If we look at the Dow was up on Friday, but understand the Dow is still in a weakened state. We're still in the red for the year. So this shows the bifurcation of the markets. The Dow is still in the red for the year, and we're halfway through the year, and the Russell is making close to new all-time highs. The Nasdaq close to new all-time highs. So when you've got this huge bifurcation like this, if the tariffs are off, you're going to see the Dow on a relative basis outperform both the Russell and Nasdaq dramatically. So being long the Dow or the diamonds and being short the Qs or short IWM, so you're playing a pair trade, to me makes a lot of sense, right? You can see we're still in the red on the Dow. Now we may see the Dow come back in and recapture and go back into the green this year on this strong going into Q2 earnings. I guarantee you on earnings call, every CEO is going to be talking about the threat of tariffs, which is preventing them from doing a lot of capital expenditure, a lot of conservation of cash, not really knowing where the tariffs are going to go. So you'll see that from the talking heads on TV. Okay, but you can see here going all the way back, volume over price, and the Dow is almost sitting right at the 24,735. That's where the max volume is. So that shows me the Dow should run up at least another 300 points this week, assuming we don't get a Trump tweet on more threats and tariffs and sanctions and things like that. So this is kind of where we're sitting here on this. But let's look at the other pins in the poke. I mean, the ones that really look ugly. And the ugliest, let's look at China. I mean, China, guys, look at the tracking index for China. It is down almost 28% for the year. I mean, from the highs made in January, almost 28%, right? I mean, if we just look at year to date, and I'm just going to do I'm going to eyeball this thing here, just kind of come down like this. Just year to date, it's down almost 20%, a little bit over 20%, right? So that is huge. So we're in a bear market in China, big time, 27.98%, over 20% from the open price. China's in a bear market, big time. If we look at the Vanguard All World Index, which tracks all the country indexes, look at this. We're not in a bear market from the world perspective, but we're clearly in a down mode, right? If I were to just kind of plot this again and just kind of put this little ruler on here where we closed on Friday, we're down about 5.28%, a little bit worse than the Dow. The Dow is down about 2 or 3%, maybe not quite that much. All right. This shows other countries are going to suffer more than the U.S. In these trade tariffs, but the U.S. will suffer, make no doubt about it. But we're getting this bounce here in these other global indexes, but China's the one that's really taking it really tough. All right. I mean, very tough. If we look at volatility now came in on this past week. Now, understand the VIX finished down this week about 10.69%. It moved down on a percentage basis, 10.69, but it finished the week at 13.37. So you can see here we're back into the green again. The prior week, we actually moved up to almost 19, and then we sold off right here. So I've removed some of my hedges. I think we're going to stay in the green going through earnings. I think it can come back down. The VIX can go down a little bit more, but we're just one Trump tweet away from the VIX just exploding higher again. So we're still on the higher band level of the green zone for the VIX. So that would suggest to me that we've got to be very careful. The VIX is still very sensitive to any of these Trump tweets relating to China and tariffs. All right. I mean, we've seen that. The market right now has not really priced in 200 billion more in tariffs, but I believe the way the market worked when these tariffs first hit the news wires over a month and a half ago that they wanted to do this. Notice the market sold off just a little bit, very slowly. They priced in some of this. They're going to take the 200 billion and start to price it in, depending on what kind of reaction and how Trump reacts to this stuff. So that's a little bit about where it's going to be a little bit difficult. If we look at U.S. Treasuries, all right, and I've said, if we look at the bond market interest rates actually went down, and treasuries are coming up to where I said they would come up to, right up in this area here. I do believe next week treasuries are going to come back down. Interest rates are going to go back up a little bit, but not much. We came down and hit almost to a T my call. My call was roughly at 140 and 22 ticks on the bond market, and we actually came down to 140 and 5 ticks. So my call was fairly close. I believe if we run up in this area here, I'm going to be more interested in taking short positions in either TLT or the bond futures market, or long positions in TBT. If we look at the 10-year interest rate, you can see here how we are down off of the highs that really sunk the markets back in January. I mean, you could see when we started moving up interest rates, you can see the speed with which the interest rates moved up. That's what sunk the market end of January, early February, with this big run up here. And then we finally topped out of this area here, and then we've just done nothing but backing off a little bit. I think we're going to be in this congested zone here for a couple of months, unless we get some interesting tweets out. But remember, the Feds are pricing in 2 more rate hikes for the year. There's over an 80% chance of a rate hike according to the 30-day Fed Fund futures by September. The bond market is only pricing in 1 rate hike for the year. All right, there is below 50% of a chance of a rate hike for December. The Feds say 2 more. So I think if the Feds were smart, they'd only hike 1 time and keep a little bit of a fundamental uplift in the equity market. But that's kind of what we're looking at right here. So net, I think the interest rates can just kind of grind around here, but slightly higher. Bond slightly lower from the closing on Friday. If we look at currencies, take a look at where we're sitting on the currency market right now. If we look at the euro is almost looking just like the bond charts. This is why the euro and the bonds, U.S. bonds, are kind of going hand in hand. I do believe we could see a little bit of upside here, but I think that the euro is going to sell back off a little bit, and you're going to see the U.S. dollar move up. And you can see the U.S. dollar here really hit the high up here, and then it's just been working down like interest rates. But I think the U.S. dollar is going to settle into a wider a zone here, and I don't see too much more downside in the dollar, too much more upside in the euro short term. Okay, that's kind of what I'm seeing here. The British pound, which we played long after the Brexit vote, after it sold off a little bit, again, we broke this upsloping channel here for the pound. As you guys know, have been following us, we've been playing this channel to the upside for quite some time. But once it got too extended here, I expected, quite frankly, for the pound to move back inside the channel, which it did. But then I expected it to halt the downward movement, but we never did get a trigger to go long. It broke the channel to the downside. It took out a key prior pivot low. So that told me that we got more downside in the British pound. I still believe there could be some more downside in the British pound. If we take out this prior pivot low sitting here on June 27th, we're going to come back down into this area here. If it gets down in this area here, then I would be interested in playing it back to the long side. But here there was clearly a short, at least down to the center of the channel, never got the trigger, and it just kept going lower and lower. Okay, so that for those of us members that took these trades, we did fairly well in the British pound. Gold, well, good Lord, gold has just been, as you guys know, I've been basically bearish gold. Neutral to bearish is kind of my official position. And you can see here when we could not get above our 2018 open price of 13,053, and we stayed here for almost 2 weeks, a little over 2 weeks. We couldn't get up above it. And in the final capitulation, gold trades the technicals better than just about any other thing, because there's nothing else that gold does. It doesn't pay dividends. It doesn't have earnings. It's mostly a fear gauge. It's kind of like trading the Bitcoins, right? And once it breaks key levels, it's off to the races. So you could see we broke this key level. It fell in literally 1 day down to the prior pivot. And the very next day it kept going. That was a signal to just stay on the shorts. And you can see we're hitting this major pivot right here. That was dated back in December of 2017, right? Major pivot. You can see on here there is no bullish divergence. This to me suggests that any upward movement in gold is going to be sold off and can take us down to the 1200 magical area down here. At that point, I'll be more interested in looking at longs. I've been on record as saying gold is going to be back up over 14 or 1500 sometime by 2020. All right, but that's a long time. When the markets start to roll over and go into a bear market, that is when gold is when you want to be adding, 5 to 10% of your portfolio into gold, either GLD or gold futures. We're not there yet, guys, so just be patient. It'll come to us, but not yet. If you want to be short or neutral, play it short to neutral. That would be the play in gold. Silver is pretty much the same thing. All right, we broke to the downside in silver on this. We try to break higher in the tighter time frame symmetrical channel, but we could not break the other symmetrical triangle, and we just came right down and we're breaking the bottom down here. So we're in this really crazy looking pattern here. I do believe that silver is going to chop around here. This is not the time to be playing long silver or gold. Let's wait for a better trigger. I did dip my toe in the water on some longs in silver right here. I'm still holding the position because I hedged it with long puts as well. So I've got kind of a hedged position here on this trade. This would be for those interested in playing silver or gold long, clearly a 2 or 3 year play. It's not for the next 2 or 3 weeks, because I think there the risk and the momentum is more downside than upside. Okay. So if you're playing it long, you definitely want to be hedged in that play. Okay. Energy. What a fakakta movement that we've had in energy over the past month. I mean, this is insane. I mean, if you look at these moves here, right? And this just shows you OPEC and Trump and everybody fighting to see who is going to come out with this stuff. If you look at the beginning of the year, you can't see it, but we had a huge move up, a huge move down, and now we're fighting this channel here, this long-term channel moving up. We took out the highs here like that made back in early January, and then we came right back down. We took out this channel. We didn't stay down here very long. That was on the increased production of OPEC. That made it back up, and then we took out our new highs here, and we're sitting at this level right here, right? That pattern looks like a bull flag. That suggests we can go a little bit higher. I've seen and talked to many analysts in the energy market. At the end of the day, you got to follow price action. All right. So no matter what they say, I've talked to analysts that believe oil is coming back down into the low 60s, down in this area down here, maybe even the high 50s. I've talked to other analysts that say oil is going to be in the high 90s, even over 100 over the next 2 years. Guys, you don't want to be making bets based on what these knuckleheads are saying, because for every one that you find that says oil is going to be at $100 a barrel, I'll find an analyst that presents also a reasonable and logical prediction, if you look at their data, that says oil can be back down into the 60 to 50 area, high 50s, low 60s. So we've got a wide range here. What we have to do, oil, somewhat like gold, it does play these technical levels very well. And when they break down, oil tends to run. So if we break the 2018 high of 75.27, we could run up. If we break this pattern here around the 72, we could run back down to this upsloping channel right here. We can see that we're really extended in June. That is a huge run off that low there. That's over like what, 13% or more off of these lows here, 14, 15% in a very short period of time. So I think it's got to digest that move. All right. Oil, when it moves like this, and I've been in, the best trade of my career was in the oil markets to the downside, but even when it was falling off a cliff, okay, oil, when it makes these moves like that, these extreme moves, it generally tends to retrace anywhere from 25, to 50% of the move, right? And then it kind of buttons down the hatches and then it comes back up again. So I would not chase oil up here unless you've got some good hedges on and short-term trade. I think the near term could be a little bit neutral to down, but again, it's all price action, guys. Oil markets is all price action. And we've had a lot of successful trades in oil this past month. We were not successful in our trade in oil just because of this huge move here, but we've had 22 wins in the row. And I believe right now we're going to settle into a kind of a range bound mode, high to low, probably for the next 2 or 3 weeks as we get through these summer months. Remember, July is the last strong seasonal month for oil, and then it tends to settle down and pull back a little bit through middle to late August into September, October timeframe, and then it starts a slow winter build again. Gasoline is even more egregious, meaning more abrupt. If we look at gasoline, you'll see here we're nowhere near the highs. Gasoline, I think the odds favor it more downside action than upside action, okay, which will have a tendency to pull everything down. So UGA would be the play in the energy markets on that. Now, if we look at agriculture, this is driven a lot by the tariffs. China needs to eat those, so sometimes they're going to be very difficult in how they want to play it. But if we look at corn, we're down near the 2018 lows down here. We've had this huge move off the highs. All right. We played corn up at this level up here. We had a successful trade and then another trade that was just a scratch up at this level here. I did not play it to the downside. These tariffs is what upset this was an unannounced move here, generally with the tariffs. So this shows you what the tariffs can do to a commodity market that's mentioned in a China press release that says we're going to slap tariffs. This shows what can happen to a commodity like that. If you look at lumber, it's the same thing, only in reverse with Canada. So now we're sitting down in this level right here. These tariffs have been factored in. So I think the risk of a bigger move now in corn looks like it's possibly to the upside, but I see limited upside movement in corn. So I'm going to stay out of the grain market, out of the ag market until we get a better picture of what's going on there. All right, everybody, that's kind of where we're sitting right now. If you're not a member, I highly encourage you to come in and join us. We're having a lot of fun here in the markets, going between commodities and equities and then sectors within equities. We've got a number of trades that we got going now that are successful. And still profitable. We've shut down. We've taken some profits in others. We're a little bit quicker to pull the trigger on taking profits right now just because of what we got. So net running into earnings this week on Friday the 13th with the banks, the JP Morgans, the Citi, the Wells Fargo, PNC, those kind of things. Options market pricing in a bigger than normal move. Both either up or down. So these will kind of set the tape for the financials and possibly the rest of the corporate earnings coming through. Okay, so members, I will see you this Sunday night as we kind of just pin down more specifics on trades and some of the things. I got a couple of new things that we're looking at here for the markets. If you're a non-member, again, come on in and join us. We're having a lot of fun. Take care, everybody. Have a great weekend, and I will see you guys, members. I'll see you Sunday evening. Take care, folks. Ciao.